Can you give us a breakdown of what even is private credit and why would anyone put money in it and why are they trying to take it out?
Yeah, so I think the simplest way to understand private credit is it's simply defined as anything that doesn't trade in the public markets. So when you go on Bloomberg and you look up a bond, most bonds have what's called a CUSIP. It is a unique identifying number, like you see a serial number on a dollar bill or something like that. Those are publicly traded bonds, right? But if you decide to, let's say, borrow money from, let's say Kristen and I decide to do a loan together, right? Kristen's a big investment bank, Kristen Kelly Inc. And I say, hey, Kristen, I want to go to you. I want to borrow a bunch of money. I want to borrow $1 billion. There's two ways we can do it, right? She can say, okay, that's cool. I'll underwrite that loan, but I'm going to syndicate it out to a bunch of other people who are going to help me take on this risk. And then we're going to securitize that risk and we're going to sell it off to investors in tiny little parcels called bonds. And each investor can come along and buy a piece of that bond and they get identical cash flows and they also get identical risk. And that way, it's great because I, Kristen, now no longer need to hold all this risk on my balance sheet. All of my cash isn't tied up in having just one loan to Jen. Isn't that great? I can go make lots of other loans because I've securitized that and sold it off. Or we can do something called direct lending, where I go to Kristen, I say, hey, I need $1 billion. And she goes, great, awesome, done. But if you're going to borrow it just directly from me, I get to write all the terms. I get to decide what this looks like. And I get to probably charge you a little bit more interest because I am tying up all my money with you and I'm wearing that risk. And so that's the direct lending model of private credit, where effectively big, what formerly were private equity firms, have expanded their operations, or you have just dedicated private credit firms where they are making those direct loans. And it's them and maybe one or two other counterparties. And the benefit for most businesses who are borrowing money in that system is that if they go to negotiate, first of all, they can close these loans very quickly. If you're going to the traditional banking system, it can take weeks or months going to the capital markets, building a book, finding all these investors, finding the Fidelities and the Vanguards and blah, 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 to all buy up pieces of these bonds and make sure that every single last dollar of that deal gets underwritten and spoken for from the investor standpoint. By comparison, private credit can close these loans very, very quickly. We spoke to a senior operator at Sixth Street, which is one of the oldest and largest private credit firms. They also do private equity. And they talked about basically turning around a loan for Airbnb during the peak of COVID, which we've just come up on the anniversary of it, in 11 days. That just doesn't happen with banks, with traditionally syndicated loans and bonds. So that's one benefit. The other benefit is that let's say something goes wrong for me, the borrower. I can go back to just Kristen and say, hey, I know you said that like I really have to maintain this kind of leverage ratio or maintain these covenants to make sure that nothing goes wrong and I haven't been in violation of these docs, but something has gone wrong. Can I renegotiate directly with you? That's a heck of a lot easier than going and finding each of those individual investors at the Vanguard, the Fidelity, the little, grandma in Idaho who's got her 401k tied up in these bonds to renegotiate all of those terms. So that's the basics of private credit when it comes to direct lending. There is a whole world of private credit beyond just that direct lending model. But I think that's the easiest way to understand it. It's that there's no visibility because these things don't trade in the public markets. And there's this liquidity premium that investors get for tying their money directly up with this one counterparty and not syndicating out that risk more broadly to investors.
Yeah, and I think I would add, so, if you're thinking about the different types of private credit, as people put it, it's worth understanding a couple of the nuances because one of the reasons why people are really nervous about private credit has to do with SaaSpocalypse. So if you think about just the world of private credit, right? Again, you as an investor, you're putting your money into some fund that's maybe managed by Blue Owl. Blue Owl then takes that money and they make loans to different players. So it could be they're loaning money to a private equity firm, right? It could be like a Blackstone. Blackstone wants to go buy, they've identified some target. Let's call it Target, whatever. I think that at one point people were talking about Target as being one of the largest LBOs, which I actually think would probably be smaller than Warner Brothers, but regardless. So they identify some company, they want to buy it. It costs $100 and they're only going to put in a tiny amount, like call it 200. How much? I said $1,000. They're putting in 200. They're borrowing 80 from somebody else. Who are they borrowing it from? It's that private credit firm. But the point is that's what's called acquisition debt. because they're lending in some deal. You also have project debt. And so that's what we've started to see with a lot of these data centers where you have Meta or you had CoreWeave. Actually, apparently the CoreWeave, I think it was Oracle data center that was going to be built is now being pushed over to Meta. But for example, if you want to build this project, this data center, you need, again, debt to finance it. And so you could borrow it, like I said, from that fund. And then there's the direct lending that Jen was talking about. But what's important to understand is that, especially with the private equity piece, a lot of the acquisitions that they did where they needed that project debt was for companies that were in the SaaS sector. And so that's where people are starting to get nervous about, oh my God, are these, we've lent money to these companies. Are they going to be able to lend or pay us the money back? Because here's the thing, right? You think about just like corporate finance 101. You got debt and you've got equity. Equity, you put your money in, that's risky, right? You're getting paid the highest reward because the money can go, like, it can go to the moon, it can go to zero. You can get wiped out completely. Debt, on the other hand, is different. It's literally a contract. Like you are giving someone money. In exchange, you're getting interest, and then you're supposed to get paid cash back. And what's interesting, too, is that typically, even if those companies go bankrupt, you should be getting some recovery. Like there's a bankruptcy and at some point they work it out and you can like take over the business. You can take over the physical assets. If it's like the data center, you now own a whole bunch of that stuff. You can recover money. So debt is much less risky than equity. So you get paid less for it. However, in this private credit world, because you're supposed to be tying your money up longer, right? You can't just like go sell it in the public markets the way you can with a bond. You buy it today, you can sell it tomorrow. You're tying your money up longer. And in return for that, you get paid more. And so that's this idea with private credit is that individual investors, whether it's these institutions or, now it's getting this push into retail, they invest in these things because they're supposed to get paid more for what's called that illiquidity premium. And so that's this whole thing right now where it's like you have a lot of investors who are getting spooked about the idea like, oh my God, these SaaS companies will be able to pay their money back. I actually don't know that that's the case, but there's a lot of panic. And so people want to pull their money out. And now all of a sudden, that's why they're like, we got a gate. Because again, if you start just like selling shit, you have Boaz Weinstein coming in offering 65 cents on the dollar. Cool. Do you really want to sell at 60 cents on the dollar when like it's really worth more, but people are just panicked? I mean, again, probably not. So again, the gating thing that we've talked a little bit about, that's why I keep saying it's a feature, not a bug. I mean, it is a bug and it sucks if you're an individual. And also I think that like there needs to be a lot more restrictions on who you can take money from and the disclosure about the potential for gating, because I think a lot of people just like don't realize that this is possible. But again, there's a reason that it's there. You're getting paid a higher return because of that, because of the illiquidity. So I'm going to shut up for a second and just see if like you guys have anything you want to say about that or questions that we can help with.
Hey, you made it to the end of the clip. That means you're probably enjoying this. And if so, just know that you can catch us live every Tuesday and Thursday at 12 p.m. Eastern. And if you want to see the full version of this episode, you can click the link in the description down below. Otherwise, YouTube thinks that you will enjoy this next.